In business tonight, China's largest state-owned banks reported higher third-quarter profit, even as margins continued to shrink for some. Now, all the banks reported a surge in so-called other operating income without elaborating. Now, some benefited from lower provision charges. ICBC, China's largest bank, said net income rose 3.8% on year. Agricultural Bank of China logged the highest rise in profit of the group at 5.9% on year. Net income at Bank of China climbed 4.4%, while the Bank of Communications reported a 1.2% gain. China's $61 trillion banking industry has been struggling with record low margins, falling profits, and rising bad debt as they head Beijing's directive to support the sluggish economy with cheap loans. These are offered to cash-strapped local government financing vehicles. To help alleviate the property slump, lenders were also told to cut mortgage rates. Last month, China unveiled its biggest package yet to shore up growth, and this includes slashing policy rates and interest rates on $5.3 trillion in outstanding mortgages. Major banks cut their deposit rates earlier this month, the second time this year, as they try to salvage margins amid weakened profitability. Now, for more analysis on this, we're now joined by Shijin Chen, Head of China Financial and Property Research at Jefferies Group. Ms. Chen, welcome to the program. Now, a barrage of Chinese bank earnings today. All of them announced higher profit, apart from China Merchants Bank, which yesterday, of course, reported a 0.7% fall in net profit. What made up for the other operating income that appeared to boost profit?
Good question. So first is that we definitely see a significant increase in other income when banks reported their revenue, as you mentioned. The other income was mainly made by the trading income and also the investment income. So quite a large proportion of that is the change in the fair value, which when we mark to market for those invested securities. Since most of the bank's invested securities are bonds, and also in the third quarter we see the interest rate decline, and therefore the fair value of those investment securities, those bonds, actually increased. So that's one of the key contributors for the revenue this year.
Given the Q3 results are unlikely to reflect the impact of the recent stimulus blitz, how do you see the latest cuts in lending rates and RRR affecting the bank's earnings in the next few quarters?
Good question. So first is that regarding to the RRR cut, it helps a little bit on the liquidity, but actually in the whole year this year, the banks don't have any liquidity issue till now. Most of the banks are hesitated about very weak credit demand rather than the deposits. If we look at, for example, CMB's loan growth and versus their deposit growth, the deposit growth remains quite strong, more than 7%, while the loan growth, especially the personal loan growth, is problematic due to the weak property market and also the weak consumption. So RRR cut actually doesn't help much on the bank's earnings. While the loan rate cut, including the LPR cut and also the mortgage rate cut, will have some negative impact for bank net interest margin. In the third quarter, we actually see bank net interest margin stabilize quite a lot. If you look at a quarter-on-quarter change, the net interest margin only declined a little bit and also even improved for several banks. But in the fourth quarter, we expect more quarter-on-quarter net interest margin contraction.
All right, and we saw that the overall new bank lending jumping 77% on month in September. Is this momentum sustainable, particularly as Chinese firms invest in factories overseas to work around tariffs from the West?
Gotcha. So first is that when we look at a bank new loan, we mainly look at year-on-year rather than month-on-month. Because there are quite a lot of seasonal factors. For example, every year, the March, June, September, and also January are quite strong in terms of new loan. So normally we don't look at month-on-month. In September, the year-on-year data, the year-on-year still remains relatively weak, since like the weak credit demand, especially like property sector, remains quite weak. The transaction year-on-year remains quite weak. So in September, we didn't see we didn't see too much improvement in the new loan. And second, regarding to your question about like China companies' overseas expansion, we actually don't see too much impact to the loan. On one hand, is that the overall overseas business for China banks only account for around like less than 5% of total loan. And second is that when we talk about new loan in China, we normally talk about RMB new loan rather than the foreign exchange or the like overseas loan. So basically, the new loan we just mentioned, like either the month-on-month or year-on-year are focused on the RMB loan. The impact from the overseas bank business is not significant.
So not much impact, as you said. But what about loan demand from individuals? Ms. Chen, do you see signs of a recovery in credit demand from consumers, judging from the latest bank earnings?
Very good question. So first is that regarding to personal loan, we noticed that banks in the third quarter remains quite weak. In the past, the personal loan growth, especially the loan growth, accumulative new loan growth, would be quite consistent with the property price change. So when we see the property price, for the secondary market, property price continue to decline, the personal loan credit demand remains quite weak. And even after the stimulus in the past 1 month, while we see some recovery in the secondary market in tier 1 cities, but overall, the whole China still see the price decline. So yes, we do expect some recovery in October regarding to the personal loan, but overall for the fourth quarter, we still see the personal loan growth remains very weak. For the whole fourth quarter, we expect a very low single-digit quarter-on-quarter loan growth in the fourth quarter. In general, fourth quarter loan growth is not strong anyway.
All right, appreciate that analysis. Shijin Chen, the head of China Financial and Property Research at Jefferies Group. Thank you.